Welcome back to the deep dive. Today, we're really getting into the weeds with Nestlé India Limited. We've got their latest unaudited financial results Q2 and the half-year ending September 30, 2025. That's for the fiscal year 2025-26. And our goal here really is to go beyond just the headline figures. We want to understand what's actually driving the growth, where they're investing strategically, and how the market dynamics are shaping things for this FMCG giant. Because there's a story here about expansion and maybe some trade-offs.
Absolutely. And if you just pull out one key takeaway straight away, it's this. The results are all about volume-led, double-digit sales growth. They're not just relying on price hikes here. People are actually buying more Nestlé products. Total sales were up 10.9%. Domestic sales pretty much matched that at 10.8%. And get this, the domestic sales figure, 54,110.2 million. So that's what, 5,411 crore? That's the highest figure they have ever recorded in a single quarter, ever.
Wow. Okay, so highest ever domestic sales, driven by volume. That suggests consumers are really sticking with them, but driving that much volume, especially when costs might be rising, that sounds challenging. So the big question for us is, how did they pull that off? And what did it cost them, maybe in terms of margin?
Exactly the right question. So let's look at the core financials first. Profit after tax, the PAT, came in at 7,532.0 million, or 753.2 crore. And the earnings per share, EPS, was 3.90 for the quarter. But that EPS number needs some immediate context. It's not quite as straightforward as it looks.
Okay, why is that? What's the context we need here?
It's because of a pretty significant event back in August 2025. They did a 1.1 bonus equity share allotment. Basically, they doubled the number of shares outstanding, bringing the paid-up capital to 1,928.3 million.
Okay, so double the shares means the earnings are spread thinner when you calculate EPS, right?
Precisely. So, to make any meaningful comparison to last year, they had to go back and restate the previous period's EPS figures as if those bonus shares had existed then too. Otherwise, you'd be comparing apples and oranges.
Right, makes sense. So if we adjust for that bonus issue and look at the real underlying performance compared to last year, what does that restated EPS tell us?
Well, there's one more adjustment needed. In Q2 of the previous fiscal year, FY25, they had a pretty large one-time gain from selling off some business assets, about 2,908.2 million. If you strip that out, the restated comparable EPS for Q2 FY25 was actually 3.88.
So 3.88 last year restated versus 3.90 this quarter. That's pretty marginal growth on a like-for-like basis.
It is, and this really highlights that strategic tension we mentioned. Getting even that marginal growth wasn't easy.
Because they were facing some serious cost headwinds at the same time.
Exactly. Look at the cost of materials consumed. As a percentage of sales, it jumped from 43.6% in the comparable quarter last year up to 45.8% this quarter. That's a 2.2 percentage point increase. That's a significant squeeze on their gross margin right there.
Okay, so this is really the core of it, isn't it? They absorbed a big hit on input costs over 2 percentage points and probably couldn't pass all of it on to consumers, yet they still managed their highest sales quarter ever and kept comparable EPS almost flat. It sounds like they literally sold their way through the cost pressure by pushing enormous volume. Let's unpack how they move so many units.
Yeah, the product strategy is absolutely central to that volume story. And the reports make it clear this wasn't just one product carrying the load. 3 out of their 4 main product groups delivered strong double-digit growth, and importantly, it was driven by volume.
I have to say, the KitKat detail really jumped out at me. Let's start with confectionery. KitKat was their biggest growth driver, kept gaining market share. And here's the kicker. India is now the second largest market for KitKat globally for Nestlé.
It's huge, isn't it? And the report directly links that achievement to their distribution strategy. It's not just about selling more in the big cities. They explicitly mention expanding numeric distribution, especially pushing deeper into rural areas. They're making it available to more people in more places.
So it's a volume play through wider reach. But they're not just focusing on the mass market, are they? I saw mentions of premium products, too.
No, absolutely not. They're playing both sides. They expanded the premium KITKAT Delights range, adding salted caramel and hazelnut variants, and they also launched a Polo Share bag. It's a classic dual strategy. Penetrate the mass market for volume, but also offer higher margin premium options to capture more value.
And we see that same kind of dual approach in prepared dishes and cooking aids, right? Magi noodles specifically drove strong double-digit value growth for the category, but it was based on accelerated volume growth.
Exactly. And here the strategy gets even more nuanced. For rural markets, the focus was on targeted pricing for Magi noodles to grab market share pure volume. But for urban consumers, it was more about innovation, like the digital-first launches of Magi Double Masala and the spicy range. Different products, different channels, different consumer needs.
Wow, so they're essentially running parallel playbooks. Targeted pricing for rural volume, digital innovation for urban value. That must add a layer of complexity to managing everything from marketing to logistics.
It definitely does, but it also diversifies their approach. If one area faces headwinds, the other might compensate. And you see a similar balance in powdered and liquid beverages. Growth there was robust, driven by, on one hand, affordable price point packs, crucial for bringing new consumers into the fold, and on the other hand, premium stuff like Nescafe Gold and the roastery range to encourage upgrades. They even expanded Nespresso's reach onto Amazon.
We should probably touch on the area that wasn't quite as strong: milk products and nutrition. The performance was described as mixed.
Yes, it was mixed overall. But even within that, there were bright spots. Specific segments like milkmaid and toddler milks actually delivered strong growth and gained market share. So it suggests the underlying trends might be improving, even if the whole category wasn't firing on all cylinders.
Oh, and we shouldn't forget the newer businesses, pet food, specifically Purina Friskies, had high double-digit growth and hit its highest turnover since integration. New variants like meaty grills seem to be doing well. That diversification matters. Okay, so we've seen the product strategy driving volume. Now let's look at how they're getting those products to consumers, the distribution channels. Today, it's all about being omnichannel, right? Being accessible everywhere.
And the channel performance reflects just how fast the Indian market is moving. E-commerce kept up strong growth, no surprise there, but the acceleration was really noticeable in quick commerce, those super fast delivery platforms. They apparently leveraged festive demand and launched higher value items like those KitKat delights specifically through quick commerce. That makes sense. And then there's the sometimes overlooked channel, the out-of-home business, which they call Nestlé Professional. This was another standout. Strong double-digit growth. And here's a really impressive stat. India is now the fastest growing oats market for Nestlé across all of Zone Asia, Oceania, and Africa. And it's become the second largest in size within that huge zone.
That's quite an achievement, fastest growing and second largest in the zone. Is that sustainable, though? Or is it just a kind of post-pandemic rebound they've really capitalized on? Should we be concerned it's a temporary boost?
That's a fair question. The commentary suggests it's more than just a bounce back. They point to innovation within Osh, like expanding the Made with KitKat range for cafes and restaurants, and their KitKat spread gaining traction with chefs. That suggests they're embedding themselves deeper into the professional food service sector, which usually means more stickiness.
Okay, that adds some context. And all this sales success, this growth, it seems to be fueling further investment, right? They mentioned adding a new Maggi noodles production line in Gujarat.
Yes, at the Snand factory. It's a clear signal of their long-term commitment and future focus. Management stated their strategy is to accelerate investments in both brands and manufacturing capacity. Their mantra seems to be fast, focused, flexible to keep driving that penetration-led volume growth. They're backing the strategy with capital expenditure.
And connecting back to cost and making things affordable for consumers, they mentioned the recent GST rate changes. How did they view those?
They see the amendments quite positively. They expect them to help stimulate consumption and improve affordability. But the really smart part, the company explicitly said they're passing these GST benefits directly on to consumers.
That is smart. Instead of pocketing the difference, they're using it to lower prices further, which reinforces that core strategy of driving volume and building market share, even if it means sacrificing a bit of short-term margin gain. It's like an investment in future sales. All right, so we've talked strategy, products, channels. Let's shift to the financial outcome of all this activity. How's the balance sheet looking, particularly the cash flow?
Very healthy, actually. The net cash generated from operating activities is a really positive sign. For the first 6 months of this fiscal year, ending September 30th, it jumped to $23,140.5 million. That's a big step up from the $17,159.2 million in the same period last year.
That's a substantial increase. What does that tell you?
It suggests they're managing their working capital really well, things like inventory and collecting payments efficiently. They're converting those record sales into actual cash effectively. And their total cash and cash equivalents stood at a solid euro 3,455.0 million at the end of the period.
Good. Strong cash flow gives them flexibility, especially when dealing with risks. And speaking of risk, let's look at the commodity outlook. This is always crucial for margins, right? What are they anticipating?
Well, the cautionary statement gives a bit of a mixed picture, as usual. On the positive side, they expect milk prices to soften a bit after the festivals as the flush season begins. Coffee prices are also expected to stabilize, maybe even decrease, thanks to decent crops expected in Vietnam and India.
Yeah.
And cocoa, which has been all over the place, might balance out globally, mainly because demand is expected to cool off a bit.
Okay, so some potential relief on milk, coffee, and cocoa. But there's usually a but, isn't there? Especially with prepared foods and snacks.
You guessed it. The sticky point is edible oil. The outlook is pretty clear. They expect edible oil prices to remain firm and possibly even rise further because global supply and demand are tight.
Ah, and edible oil is a key ingredient in, well, a lot of their portfolio, right? Magi, snacks, some confectionery.
Exactly. So that forecast for firm or rising edible oil prices poses a direct challenge to that 45.8% cost of materials figure we talked about earlier. It means the pressure on margins isn't likely to disappear anytime soon.
Okay, so let's try and pull this all together for you listening. What we're seeing is Nestle India executing a really quite sophisticated strategy. They're driving massive volume growth using affordability and deep rural penetration, but they're also protecting overall value through premium innovation, particularly aimed at urban areas and using fast channels like quick commerce.
That sums it up well. But the final thought really loops back to that tension we identified right at the start. Their stated strategy is explicitly penetration-led volume growth. That's the goal. Yet the reality is a key input cost, edible oil, looks set to remain high, potentially even increase.
Which leaves us with a critical question going forward, doesn't it? If edible oil costs stay firm, what other levers can Nestle pull beyond just tweaking prices here and there to stick to that volume-focused strategy without letting margins get squeezed even further? Finding that balance, maximizing units while protecting profit, that's the tightrope they'll be walking. And that's our deep dive on Nestle India's Q2 results. Lots to think about there. The sheer scale of that KITKAT number, the OOH growth. What stands out most to you? Thanks for joining us.